Welcome ADK Wealth Advisory Group community as well as Financial Planning World community. Dan Davis coming to you from my Franklin home office on a very snowy January 10th. What we're doing today really is looking back 2024 and then looking forward to 2025. With all of that said, I'd say on a personal level, probably 24 would be sort of like the tale of two cities, in that, you've got for me personally, many of you saw on a market update in the summer that I had communicated that Mary Kay and I got divorced after 25 years of marriage. That was really a low point for 24 for me. Really the difficulty of that was more in 23, and 24 was just more wrapping everything up. But then, you've got, as life has it, the beauty of it is then Morgan and her husband Scotty, who works in our firm, had their first baby, my first grandson. So Baker came into the world a little bit more than a month ago, and he's doing healthy. So is mom, and Scotty's Morgan are doing a great job as new parents. So 2024 also had some what I would classify as crisis feel to it. Many of you have heard me discuss the Fourth Turning book that I've read. It goes back into the late 90s as the authors culminated a theory that basically says in the Western civilization you have these 100 plus or minus year cycles with 4 sub-cycles underneath, the fourth one being crisis. And we're definitely in that. They predicted it sometime around 2010, I would say. I think it started 07, 08. If it lasts 20 years, we've got, a few more years left on it. I think it's probably more into the period where Social Security, Medicare, Medicaid, all those major systems implode. And why I start there is that when you have a crisis backdrop, your paradigm from watching the TV, looking at the news, having conversations with people is filled with a prism of crisis. But if you take a look at what's happened in 2024, it shows that we have to make sure that we're looking at data, because the reality of it is that we can make money in crisis periods, even though it doesn't feel as good as when we're making money in periods that are much more jubilant. So if you start with, say, the bond market was one of those types of things that underachieved last year. We expected the bond market to do like 4 to 6%. And going into the December Fed meeting, it was on pace to be on the higher end of that because of the hawkish tone and the bond market's over anticipation of rate lowering. The reality of it is that there was a big sell-off, and the bond market ended up less than 2% for the year. The bonds that we managed for our clients did a little bit better than that, but still exceeded what our expectations were. And the why behind that gets down to an imbalance between the Fed's policy and what the market's anticipating, and then sell-offs. I believe that the Fed and the market are more in line now going forward to 2025. Our expectations are higher for 25 than they were for 24 with bond returns, because I think some of that most recent sell-off that's continuing because the interest rates in the 10-year are rising. I think that's an exaggeration, or the pendulum swinging too hard. So our expectations for bonds this year are more like 5 to 7. So time will tell. If you over analyze things and try to get into the myopic, sometimes it can be a little too much in the bond market. But you could oversimplify it and basically say inflation is not as tamed as what the markets want, what the Fed wants, and the economy is doing better than what's necessary for the Fed to be lowering rates. So the stock market is the exact opposite of that. Whether you look at the S&P or the NASDAQ, did significantly more than our expectation, which was that low double-digit returns. Both of them ended up over 20%, which is pretty spectacular. Dow was significantly under that, and the reason why is that if you break the market into growth and value, you have times where growth exceeds, value lags, and vice versa. We're in the period right now where growth has been exceeding value really since the last major pullback in 22, and then the previous pullback because of COVID. I think we're in a period where growth will outperform value when the markets are moving forward, and when they pull back, value will hold up better. So that's sort of the ballast between the two. We're about equal weight with slight overweight to value, and will stay that way for the foreseeable future. If you really take a look at what our expectations are for 25 with the stock market, it would be high single digits to low double digits on the S&P. Call it 7 to 11. Sounds like it's got a lucky ring to it. And all of that being said, I expect the biggest risk around all of that to be geopolitical. And if you talk about going back into 24, I'm stunned that the market didn't have more challenges as a result of the geopolitical stuff that was going on. So as long as the economy is holding up and as long as things don't implode, the geopolitical sort of rumbling will be exactly that. But if there's a shock, the markets are just not strong enough to handle that. If you go mid-December of 24 to now, the stock markets have been sideways, kind of choppy. You've heard us talking about that. You'll also hear that phrase as a consolidation. That's what's going on. When you're in the midst of consolidation, you never know, is that an extended or short? When it ends, does the market go up or go down? It wouldn't even weigh in on that. But barring a geopolitical shock, I would say the trend is towards up. The other thing that I think is pretty fascinating that I get a lot of questions on is the crypto markets. In the U.S., we have a hard time getting our mind around crypto because candidly, it doesn't have a very usable reality in our economic system. But if you're a Nigerian oil guy, a oligarch in Russia, the list is long. There really are significant needs for crypto. And it's our belief that while it's a very speculative asset, it's here to stay. You've got some of the really big ones like Bitcoin, etc. Those are the leaders, the dominant players. I believe they're here for the duration. And then you've got these offshoots that have all these different bells and whistles. Me personally, I'd stay away from that because it's like trying to invest in a startup company that is trying to figure out who the next Microsoft or NVIDIA is going to be. If you hit it, it hits big. If you don't hit it, it's more likely, then you kind of lose your money. So crypto, speculative asset, the things driving it right now, one is growth and speculation are doing the best, so that's a key backdrop. Two is the SEC and regulations have lightened up to where you can now actually invest in an exchange-traded fund, an ETF, in crypto, which really opens up a marketplace so people don't have to go get a wallet. A lot of people aren't motivated to do the wallet, those kinds of things. They don't understand it. Now they can do it in an approved security, which opens up a whole new venue of investment. So I think that's driven it to where I would say that I think crypto does form bubbles more than any other asset. I think we're either in that bubble now or close. And then if we've only purchased crypto for our more speculative clients, if that's something that you're interested in, I would not buy it until some kind of an implosion happens. And I wouldn't buy it in our models. I would basically wait for people to bring that up as something that they want because most of our clients aren't speculators. Gold is another one that's kind of fascinating. If you go back and you take a look at 2024, really you'd go into the fall of 23, which is when gold really started its post-COVID second-tier run, and it's still happening. And that doesn't shock me with the backdrop of inflation that I previously talked about. We don't own any gold right now. We sold out of our gold some time ago, took a significant profit, and it worked out nicely. And if I were to sort of say, why is all of that happening? It's realistically because the economy is doing really well in the United States. You'll notice when you look at your investments with us, we are the most U.S.-centric that we've ever been. And the reason being is the U.S. economy is doing better than the rest of the world's economy. And we think that trend continues for a while. I'm going to go back to stocks for just a second because there was a point I wanted to make in that something happened the first time that I've ever seen in my 38 years doing it, and that we went into 24 with growth being somewhere between high premium valuation to bubble. It was closer to high premium than it was bubble. And so what I mean by that is that it was overpriced. And so that, coupled with some of the stuff around the election and geopolitical risk, we trimmed some of our growth back at a pretty good profit. The thing that happened that I've never seen before is that growth continued to go up, and the PEs, the valuations, went down, and the math of that says that corporate earnings basically grew enough to cause valuations to come down in spite of that continued growth. Normally what happens is you either get a consolidation or a pullback, and that's how the PEs get normally back into a reasonable, pardon me, normal space. But I like the fact that it happened because it made us a lot of money. Getting back to the economy, you've heard me talk about that it goes through stages. And the economic cycle always ends in what I'll classify as end cycle with a recession. And then, as you remember, when that happens, you then start to cycle over recovery, mid, late, end. We're in my opinion, that mid stage right now. And we're towards the back nine of that mid stage. Why that's significant is that there's no real risk of recession in the next 12 to 18 months based on data. A shock could cause that. Again, that's that geopolitical stuff we were talking about. But that is something we would respond to, not try to predict, because it's unpredictable. Why do I bring that up? I bring that up because even in spite of the fact that we're in a crisis season, valuations are on the high side. They're not at the premium levels they were before. We're still very optimistic because of what the key driver is, and that's the economy. The Fed in December announced and made it more clear, and I think the bond market's starting to pick up on it. It took them a while. That the Fed's going to be lowering rates next year, but not nearly as much as what we thought, what the market thought. Candidly, if you take a look at the Fed's policy, LPL's research team, and what we were saying to you was more on spot than what the bond market was predicting, and I thought the bond market was being very Pollyannish. So in summary, the economy is doing very well. The geopolitical risk you've heard me weave in throughout this whole thing, that is the essence of the key risk. We do have valuation risk, that valuations could drive up and cause problems. The main thing is geopolitical stuff, whether or not that's the U.S. misbehaving with policies like, making comments like we're going to put trade war stuff on Canada and this invisible borderline in Greenland and all that. I don't know what to make of that other than it's not good policy from the leader of the world in the United States. That said, as you heard me talk in previous videos years ago when Trump won his first election, I went back and read The Art of the Deal, and why I read that was to understand him. And if you take a look at his mode of operandus, it's simple. Create chaos around something you're trying to get, and then negotiate deals that chaos creates opportunity for you to extract more than what you would have got if you went in a normal protocol fashion. There's nothing normal protocol about Trump. I would imagine much of that kind of bluster is exactly that. It's chaos that then allows him to negotiate things. If it were just real estate deals, I wouldn't even bring that up. But the reality of it is the most powerful nation and the leader of the world, when you create chaos and you're already in a crisis environment, it just creates a lot of negative headlines and a lot of reality that would probably be better off not there from a social economic standpoint. Whether or not he gets better deals from it, that's yet to be seen. If I were going to summarize all this in a nutshell, 2024 total portfolio returns exceeded what we expected because the stock market did so well. 2025, we're very optimistic because of what I alluded to. Bond market, I expect to do better, but really choppy. Stock market, still really good, but nothing like last year. And if I were just going to sort of wrap up, I'd wrap up by letting the people who are our clients, our friends, and our family out in the California area that are affected by these wildfires, and some fires which may have been started. Mia's lives out there, as you know, in Calabasas, and she had to evacuate a few days ago, and her literally apartment's on fire. And what she's been told is that it was started by someone who's now under arrest. So, again, hard to say what all that's about, but our prayers go out to everyone that's affected by that. And I want to thank you as I start my 38th year for your trust and all the things that you give us permission to do for you. We'll do our best job. And thank you, and signing off from Franklin. Happy New Year.